Let's talk about the second half of the strategic profit model, the asset management path. All of the information that you need to analyze the asset management path can be found on the retailer's balance sheet. So at this point in time, you might want to pull out the balance sheet that was posted in the Chapter 6 content folder so you can use that to follow along with the conversation. The balance sheet summarizes a retailer's financial position at a given point in time, and that's typically the end of the fiscal year. So let's do a brief recap of the components that you'll find on the balance sheet. First, you'll find the firm's assets. Assets are economic resources that are owned by the retailer. So this is everything from your inventory to your store fixtures, any cash you have on hand, accounts receivables, and generally you'll see another category on most balance sheets. Current assets are assets that can be converted to cash within 1 year. So if a retailer was in trouble or they needed some money to pay off some liabilities, this is money that they could get to pretty quickly. So the retailer also has fixed assets. And fixed assets are assets that really cannot be converted to cash within a year. So this would be things like your buildings, your fleet of trucks, if you have those, any type of warehouse or distribution center that you might own. It could be your computer systems, your IT software. All of that is in a fixed asset because it would be really difficult to convert to cash within a year. So you have the balance sheets in front of you. And so we're going to go ahead and talk about a couple of the components of the asset management path. So when we are looking at asset management, we start by looking at inventory turnover. Inventory turnover is a measure of productivity of your inventory. So it shows on average how many times inventory cycles through your store during a specific year. And so normally we will use our inventory balance at the end of the year to calculate this. But in order to calculate inventory turnover, you look at your cost of goods sold and you divide that by your inventory. So you do need to go back to your income statement to locate your cost of goods sold for both Macy's and Costco in order to be able to calculate the inventory turnover for both of these firms. So with inventory turnover, as you might expect, Costco has a much higher inventory turnover than Macy's. And this is because Costco sells commodity and food items, and so people buy those quite often. So just think about it from a consumer perspective. How many times a month do you go to the grocery? And you as college students, it might be a little more irregular, but think of your parents and how many times a month do they go to the grocery? They probably go once a week. So if you think about that turnover, food and other commodities go off the shelves pretty quickly. Compare that to Macy's, a department store, and think about, the sunglass station or the jewelry department, even the apparel department. People aren't buying apparel on a weekly basis, right? It's less frequent throughout the year. So their inventory turnover is a little bit smaller. Let's look at asset turnover now. Asset turnover is a measure of your performance of asset management. So we're now looking at our net sales divided by our total assets. This runs similarly to inventory turnover here. Costco, since we're looking at our assets here, we know that Costco turns over inventory much faster than Macy's. And so as you can imagine, Costco's asset turnover is going to be a lot higher than Macy's asset turnover. So when we combine the profit management path with the asset management path, we can finally get to our return on assets, which measures success for the retailer. So we're going to take our operating profit margin percentage, which we calculated when we looked at the profit management path for both Costco and Macy's, and we're going to multiply that by the asset turnover in order to get ROA. And so when we look at just the profit management path and we look at just the operating profit margin percentage, we can see that Macy's is outperforming Costco. When we look at the asset management path, however, Costco is outperforming Macy's. So if we want to look at the overall performance of these retailers and determine which retailer is operating more successfully, we have to merge the paths here. All right, so we can see that when we look at ROA, Costco has an ROA of 10.5% and Macy's has an ROA of 10.8%. So yes, Macy's is outperforming Costco, but just by a very little bit. So we could generally say that Costco and Macy's are equally as successful. So if I'm an investor looking to invest in one of these two retailers, it might be a pretty tough choice. So just to kind of wrap up our conversation on ROA, the strategic profit model does assume two different things. We know that retailers have to consider both profit margin and asset turnover when they are evaluating performance. And we know that they need to consider the overall implications of strategic decisions that affect both components of the model. So, with profit management, it's looking at our cost of goods sold, what we're paying for the merchandise, and it's looking at our selling and administrative expenses to determine if there's areas we can lower those in order to get a higher operating profit margin. On the asset management path, it's looking at our assets and determining if we're using those effectively. Do we have the right amount of inventory in stock? And, are we collecting our accounts receivables on time? So, we have decisions that impact our profitability, and all of those decisions help us to get a higher ROA. So in your textbook, there's a chart in chapter 6, and it gives you the breakdown of some of the different financial components for lots of different types of retailers. So you can see there's a list of department stores, discount stores, specialty stores, category specialists, and even some supermarkets. And so that might give you an idea of how each industry and each type of retailer performs. So I want you to look at that chart, and I want you to think about their financial measures. So how do department stores compare to discount stores, compare to specialty stores and supermarkets? And try to determine which part of the strategic profit model each of these different types of retailers should focus on. If I'm JCPenney, should I be focusing on profit management, or should I be focusing on asset management? So you can think about that and talk about your thoughts in the chapter 6 discussion boards. There's one more topic we need to cover in chapter 6, and that's performance measures. Overall, financial performance uses ROA, but that's just one way to measure success in retailers. So a lot of times retailers will set other types of performance measures that they can try to meet or exceed. And so this is Exhibit 612 in your textbook, and it shows us other types of productivity measures that retailers use when evaluating performance. So that last column there on the right gives us a look at the measure, the ratio, and then we can see the outputs and inputs we need as well. So I just want to look at a couple of these and bring them to your attention. If I'm looking in the productivity column on the right, ROA is at the top, obviously. Asset turnover is very important. And then you see sales per employee and sales per square foot. So these are measures that we have already talked about this semester. We know sales per employee is very important from a people perspective, and we know sales per square foot is very important from a presentation perspective. So a lot of times retailers will use these productivity measures to try to determine if they can increase sales either per employee that they hire or per square foot of selling space that they have. So those are very important. And then going on down the list, a lot of retailers will look at their advertising expenses. They'll look at their utility expenses, their SG&A. They'll look at inventory shrinkage. So there are lots of other productivity measures that retailers use in addition to the ROA. So think about the retailer that you're finishing up for your project this semester, and see if you can identify a couple of performance measures that you think would be incredibly important to that retailer. So if you can think of a retailer and the types of productivity measures that would be important to them, that's something you can discuss in the Chapter 6 discussion boards.